you're a property investor investing in the United Kingdom and you haven't heard of family investment companies, you're literally handing over millions. Because here's the truth, the UK's wealthiest have been doing this for a number of years to protect their family assets and legacy. By the end of this video, you'll know how to protect your assets and pass that legacy and use family investment companies. My name is Z, I'm a chartered accountant and a tax advisor who specialises in property and using family investment companies to protect your family and legacy from the dreaded IHT. And we're getting to the fun of family investment companies. I'm going to try to keep it fluid because there's a lot of stuff and it's not straightforward. And it's trying to make sure we cover all the stuff. What I'm going to do with family investment companies, before I start, what is people's knowledge on family investment companies? Anyone got some knowledge or any insights? Yeah, go on.
Yeah, so I understand them to be a trust.
What did you say your name?
David.
David.
I understand them to be trusts, basically, in their most simplest form.
Sort of. They're a hybrid. No, but it's a good point. So they're a hybrid. So there is different variations, by the way. The ones I'm talking about, good old Parliament had a body look into them in 2021, found out, as a lot of the MPs follow us as well, the MPs have nearly got all of these. So they're great tools. They're a combination of a limited company, an SPV, special purpose vehicle, with a trust combined in it. So it's a combination of both. That's the ones I'm going to talk about today because they're the most efficient tool to have if you are going to have it. And they're going to expand now with trading businesses coming into IHT from April 26 onwards. They're going to probably expand to those tools as well. There's so many different ways of using them as well. I'm going to try to keep it simplistic as much as possible so you guys can see what the value of these are. The key things with a family investment company is understanding what your exit strategy is. And there's only really two exit strategies, as I was saying on someone's podcast recently. One, that you plan it, or number two, it gets planned for you when you leave the planet. So, and unfortunately, I always ask people this question, do you know anyone who's left the planet, left their assets, come back and told the story? And someone did shout out to me Jesus once, and I said, I'm still waiting for him, he hasn't come yet. So people are like, they don't plan for this because they don't realise until they get stung. And then when they get stung once, they get stung again because it's multi-generation. So you've got to plan multi-generation. That's why trusts can be really powerful, even with the changes in trusts. So you've got to combine different aspects. So family investment companies, I'm going to cover this. I call them FICs. That obviously stands for family investment companies, right? Why they're really useful is because depending on when you start, they can diminish IHT to zero. Some of it has to be tested in case law because now they've probably been running a decade. I'm sure there'll be some challenges on different values of them. What they try to do is they have, I'm going to use a typical family investment company where it's a mum, dad and mum, then children. I hope that's okay. That can work in civil partnerships because I know there's loads of variations these days, right? So normally it is, you have the dad and mum who have what we call freezer shares. Have you heard of this concept before? Yes. Right. Basically, what we're doing is we're freezing their value, but we're still giving them all the rights for dividends and voting. So they control the company, right? That is so important, but the value of their shares is frozen. That's why this family investment company can be so, because then the IHT doesn't increase. What happens in UK property? Typically for the last few hundred years, every 10 years, doubles every 10 years. That's been the historical trend. And some places more or not, some they say 7 years, some longer, depending on where your portfolios are. So what you're doing is you're freezing the value. Then there's another share class, right? So you can have quite a few shares on this. And what you do with those is you make them dividend only shares. And these can be gifted. You've got to be careful when you do these. Just make sure, because these can be gifted to family members, preferably over 18, and depending on how they're set, they don't trigger too much CGT, if any CGT, because of the value of the share. And their pure only thing is to distribute income out of the company, right? So that's another share class. Okay, they typically have limited or no value because you don't have no capital and no voting. Does that make sense? Right, so limited value only. I'm talking at a high level because in order to do these, and I emphasize, you need an accountant, tax advisor switched on, a legal person, we use barristers, as well as a review of financing to do these. These are not self DIY tools. I'm just letting everyone know because I've had people talk about it that way and then they come and they're very upset because it didn't work. Because you need all of that to make sure it's all lined up because there's so many implications. Then we have a third class of shares, which is called growth shares. Has everyone heard of this? So this is the class where you put the capital increase in. Yeah? And this is typically on death executes into what we call a discretionary trust. I think that was what you were mentioning, the gentleman there. Brian, was it Brian? David, apologies. Discretionary trust, terrible with names, never forget a face. Discretionary trust. So David, this is where the discretionary trust comes, but that's upon death, right? So they're legal. Does everyone know between legal and beneficial ownership? Let me quickly explain. Legally is whose name's on it, a company house, generally, or land registry if it's in your own name. Beneficial ownership is who actually has the benefits from it, from a tax perspective, income tax, capital, all that stuff, yeah? So beneficially, this is going to be owned by the discretionary, and it's set up in a way that on death, it triggers it off. The reason why this is so important, and this is where the legal element quite a lot affects the tax, is if you don't do it that way, every 10 years, you're going to get stung by the 6% charge. That's how you don't get stung by the 6% charge, right? I'm explaining at a very high level. So the articles associated, legals, all the supporting paperwork, the discretionary trust, everything else has to line up in order for this to work. So this is where all the growth goes. So you've frozen the value in your estate, it's all in here, and that executes on death. And that's how you don't. But then obviously once that's done, it's normally on the second parent dying, because when it's a husband and wife or civil partnership, you have something called the spousal exemption. So you only really trigger on the second death. Yeah? It's different if it's not a spouse parent, then it'd be different. What people also do is multi-generation ones if they want on these. And that's the planning, because if you've got, if you've got grandchildren and you want all these, they can't really own shares until they're 18 years old, right? So you have to do multi-generations, and that can be quite wise. So these can go on for some time, right, if you do them properly. And what then you're doing is you're protecting the legacy. The whole point of these is not just a tax saving, it's a legacy. Because what the government, why they have not outlawed this, that was just is if you don't do this, what happens? I know some of the people have mentioned, what happens upon death if you haven't done one of these?
You get a big IHT bill.
And what do they want it in how much time?
6 months.
They don't care, do they? They will refuse to let you even change this at company house or land registry if you don't pay the bill. And then if you don't pay the bill, you have penalties, interest, and they can come after you. And therefore it cripples the business, doesn't it? The bit that people forget is educating your beneficiaries. One more thing, unfortunately people will have the dreaded divorce, so I want to mention that. Unfortunately that happens to people. By having stuff in here and educating the children, you protect against divorce. This is outside the scope of divorce, discretionary trusts. Does everyone know that? And how you take the money from this, you've got to educate the children. You do it as a loan. Very clever, because if you do it and you actually take income, then you're bringing the money into your own estate, the IHT, divorce, everything. So what people do, who are quite forward looking, is they educate the children that they loan the money from the trust, and then they get like a life insurance policy to replenish. Does that make sense? And it has to be done legitimately, legally, and all the rest of it, and they charge interest on it. That's payable on death. So the insurance policy pays the back, so it replenishes, next generation goes again and again and again. And if you get divorced and you bought property based on a loan, who gets first heads on your house? I'm giving you some advanced tax planning here. This is how you've got to think. This is how you protect legacies, because most people do not protect legacies. Because if you don't educate the children, what happens? They spunk it in the first generation. Moral language, that's what happens. Because they don't know. They close it up, they wind it, oh, it's too much headache, this, that. So the trustees of this, very important that they understand, obviously it'll be the children in the long term and all the rest, so you educate them. So important. I know it's hard when they're young, but the people you surround yourself. So there's a lot of careful planning that need to be thought about. Your wills and everything else, letter wishes, LPAs, all of this legal elements have to be brought to lined up. And I see it too many times. It's all disjointed. No one's thought about the whole picture, and these fail. I've seen a lot of these fail, by the way, because people have not understood it. They say, oh, I've done it now. No, have you actually protected it, actually got a plan? I think you were mentioning, Sarah, about 10, 20 year plan. Yeah. So that's what you've got to think about. And then where you can, the trustees and then the children, how does that actually feed in to all of this? Because if it doesn't feed in properly, these are just not great tools then.
Can I just ask a
please.
question about
I've done my bit on that, so let's go on.
When you said about divorce, it's not divorce between the mum and dad, it's when the children divorce from their spouse and you want to keep it within your bloodline then.
Exactly. Because the reason being, if the parents divorce, they've got these shares. Yeah. They've still got rights, and that actually hurts it quite a bit. So we say to people, think about this, and this is, no one's here from a legal background. Okay. Anyone? Okay. Well, my sister's a divorce lawyer, just let you know. Not a fan. They don't care. My biggest problem is with them. Because they want money, they want a divorce, they want it not to be amicable, they destroy these. And then I have to educate. I've had some big cases where we've actually, thank God they trusted me, that we protected and said, look, you're going to go separate, you're going to lose a spousal exemption, but keep this intact because you're going to get hammered. There is no benefit. Forget what the lawyer's saying, because they're just looking on what divorce looks like for them, because they want it ramped up to get the most money out of you. They're a transactional relationship. And I'm biased, your accountant tax advisor should be your number one relationship. If it's not, something's gone wrong. Because they're there to protect you. Protect, save you money, make you money. That's how it works. That's how we work anyway with people, and we've been fortunate that people have understood that. So these are sophisticated tools, but they have to be understood. And you have to then explain, because you can't expect the children to get this if you haven't tried, or you've not put trustees who you've educated and told them, please make sure you document. So I will always say, document what your letter wishes, all this stuff, because we don't know when time's going to come, right? We're sitting here, unfortunately, and we don't know. So really, really invest time in these. Then these are amazing tools, because the benefits I've just mentioned, I'm going to just quickly, and then have more questions, I guess. Benefits, IHT can be mitigated, can become low as zero if done properly, or depending on when it's done. Because if it's done when your company's ready set up, you've already got an IHT problem, right? So you're stopping future IHT, and then we've got to attack the current IHT, and there's a number of different tools to do that. Okay, so it's very good at going forward. The other bit is it can be asset protection. Yeah, because what you're doing is you've got a company, limited company, and you've got multiple layers with the discretionary trust, asset protection, so important. Also, legacy tool, which I've gone on about. I know I've gone on about. If you follow us on LinkedIn, you'll see my kids are probably more well known than me. I'll go on about legacy. Picture of them. Right? And the reason why we're here, what we're doing it for them. That's my view anyway. Everyone might have different views, but if you have got beneficiaries, whoever they are, because this is the point of this, by the way, is if you've got beneficiaries. If you've got no beneficiary, or you want the state to have it, no point doing the session on it. Yeah, you've got to have someone you're going to give this to that you trust and you're building it for. Right? And that's such an important aspect of it. So these are some of the benefits, right? There is setup costs and there is maintenance costs, right? So you've got to know, because you've got income aspects, IHT aspects. So if you go to, no disrespect, what we call a GP, general practitioner, I always use this acronym. You go to the doctor, their GP, when they see something wrong with your heart or something, you don't expect them to change their uniform and start operating your heart, do you? What would you say to them? Head out. Yeah, you say, where's the specialist? Why is accountancy tax any different? And it's most not understood. And what happens is, I see some horror cases. I'm like, oh my God, you know, it's scary because you get what you pay for, and you get obviously what you have to invest in the relationship. It's not a one-way road, it's a two-way. So you've got to be active and proactive and say, look, these are the things, have a plan, I say 10-year roadmap for people, or whatever it is, know what you're trying to achieve, how you're going to achieve it, and then your annual plans should feed into that, where you are, where you're not. Is that okay? Yeah. Right. Does that cover some of the stuff? Now let's open it up to Q&A on this bit.
I'm Tom. Yeah, my question really is, and this was touched on earlier.
Please.
I'm 46 years old. I've been working hard. I've got a decent portfolio. Blah blah blah. It feels as though potentially this works at its best. It's most optimum if it's set up at the beginning and rolling forward. What do I do about my current situation where I have kids and I'd like to set this up, but yet I've probably already got a decent portfolio? I guess that's my fear. And how do we have? It sounds like there is sort of potentially some inheritance tax liability now, when you're setting these kinds of things up. That's the one I'm not very clear on.
Great question. Always great to set it up because it's protecting the future, but then you need strategies to attack the current, right? So without going into detail, inheritance tax, how does that work? Does anyone know how inheritance tax is worked out?
Die at HMRC.
I love that. I love yeah, pretty much that, right? But the way it's calculated is it's on your gross assets less debt.
Well, that's what changed.
Yeah? So if you are taking the company, it's done on your net assets typically. So you've got to attack that, utilising, we used to use pensions quite a lot, still useful tools depending on how you set the pension up. A SAS, I'll recommend, always go and watch it, small self-administered scheme, in life insurance policies where you're going to exit. All of these will affect inheritance tax. There's a whole lot of solutions because if you're a typical dad and mum, right, you've got probably a 650k, it's probably going to be 325k each. I'm saying if you're multi-millions because you lose the 175k that good old David Cameron, don't get me started, gave in a way that it doesn't work for most people who've done well. So you've got to think about that because you've got your main house. So it's how do we attack that? How do we use multiple tools and combine them? I think I was talking to the team. Inheritance tax isn't one solution. This is to stop future and start attacking current. So you need a plan over multiple years how you're going to do that to mitigate all of those things, because there's going to need mitigation. It won't be, here's the magic pill in Matrix, you add it and it's done. Yeah. This will stop the future because this bit here is so important. The optimal time, as you rightly said, day one, but a lot of people don't know what's going to happen. And it's a bit of an investment. You know, they're not cheap, these tools. But in relation to IHT, they're priceless. Yeah. Because IHT, you know, I've had people come in the tens of millions of IHT problems and not done anything. And they've been told to reduce debt, keep gross assets. That is not from a tax. It goes back, the country's built on debt. Am I fair to say that? Therefore, the rules are to protect debt, not you.
I think most of us in the room, hopefully by the time we die in a very old age, we are looking at the multi-millions here. So we're not talking average mum and dad 300k estate, you're talking probably about 10 times that in this room. So it's the
probably
strategies
more.
And mitigation. Say let's end up with a 10 million portfolio.
Yeah.
What are those strategies to then mitigate when we get up to the 60s, 70s, 80s, and our portfolios are 10 million plus? They're the kind of strategies that we're looking at.
This will be a great tool for that, because what it will do is it frees it, right? Because whatever today's value is, you're freezing that value into the future estate. In the existing portfolios, you need to do additional aspects.
But at least freeze today.
Yeah, exactly. And then additional ones, you've got to do tools like utilizing debt, using different allowances. Pensions can still be useful. Dubai or foreign countries, depending on their tax treatment, can potentially be useful as well. So there's a number, whole of life insurance policies I recommend. If you've got good financial advice, very useful if they go in the mix with this, because you have to attack them in different ways. And it's not overnight. So anyone who says to you a magic thing and overnight I'll wipe out all your HT, I'm sorry, but they're living in a different world. It doesn't work that way. What you're doing is you're fixing the problem and you're resolving it, because it should have been done at day one, but most people don't know, and they don't know how big they're going to get. Does that make sense? So these are tools, one of a number of tools in the toolbox to attack it. You've got to think of it. I think some of the people said they've already had this pain. What's happening is your next generation are going to have even bigger pain. So I had one where someone turned up with a 30, 40 million portfolio, 15, 16 million IHT. And when you actually pay that 16 million through debt, what about the next generation? They've got the problem. Because it doesn't have a markup on death.
It's not just for property, it can be businesses that you can put into an
Potentially. Historically, there haven't been. Do you know why?
Okay.
Because there's something called business property relief.
Right.
So good old Rachel, she's watching the stuff, April 26, she's introduced a £1 million allowance for people, which is a disgrace. Because how is the trading business valued? It's valued on the owner. So she's talking rubbish, isn't she? That's why it's always been outside scope. You've got 100% relief. Right? But now that's going to be, and yes, we're going to have to sophisticated. One thing I wanted to cover quickly as well on this is holding structures. I'm going to just do a little bit here, right?
Can I ask a quick question
Sorry, go on.
before you're done?
Okay.
Do you want this?
Yeah, no, ask. I've got mine for
Hi, I'm Steph.
Love it.
Lending. What's lending like if you have this sort of structure?
Lending with anything that's not bog standard, there will be impacts.
Okay.
It depends on your broker. So we work with brokers who actually understand, because what happens with finance, putting a different hat on, if they don't understand something, what do? Yeah, because they're silly. They don't understand. So I would say if you're not working with a broker who understands property, investment, all this, you need to get one, because they should know this. I do holding in the general questions actually, and we'll talk about this, because I think that's going to be a good part of the Q&A then. But knowing all these structures, because remember, you're sophisticated property investors. You're not average Joe's got one buy to let in their name, right? And can go and buy just a product thing. You're sophisticated investing for the long term to build legacy and wealth. So you need the team to support that. Your team must have an accountant, tax advisor if it's the same person or two. You must have a lawyer that actually understands stuff like title splitting and all this, and finance, because some of these projects, I have to constantly invest in my intellectual property. Going on a special tight spin, because the team, you can't have one person with knowledge. You've got to have a team. Normally, I say your quarterback is your accountant, tax advisor, because they know your personal affairs, the company affairs, and they will make sure that that's compliant. But you do need a team. I'm going to be emphasizing, because they can't do everything, none of the others can. Because I've had lawyers who have not been up to the game, and no disrespect, but they're so important as well. They're specialists as well. Financing people, even bigger headache. Wrong financing person will cripple your business. I mean a good finance broker. Yeah, because as you're going up, you might need commercial finance, bridge finance, all the different types of finance, multi-freehold buy-to-lets. These are people who have to know all of what I'm talking about. Does that make sense? Did that answer the financing question?
Yeah. Is there what particular lenders do you tend to find?
It's not the lenders.
It's not.
It's the broker who has the conversation with the lender.
I feel like
Because
I've
the
got a
lender.
broker, but I'm excited to ask her if she knows about.
Yeah, ask them
Yeah.
and ask them what relationship they got.
Yeah.
So I had, I'm not going to mention the name, someone came up, they're trying to buy their own house, like $1.5 million up in Manchester, beautiful house. They went to Barclays direct, no disrespect, Barclays, waiver, right, is they didn't do it. But then when they got a broker, when the conversation, suddenly it happened. And I said to them, this is how it works.
Yeah.
We're forgetting we're humans. The computer said no is ignorance. We all know that, right? So if you go to a person who's going to rely on a computer application system, you already know they're not at the races, because their job is to build relationships. So if you come to me and say, I've got HMRC defense, which I'm doing, I've got no relationship with HMRC or haven't developed them, it's going to be hard, isn't it? Does that make sense? Because you've got to build relationships with people. We're in the people business. Number one skill, build relationships with people, then negotiate and communicate what you're trying to do. And that's what I found with most successful entrepreneurs. They get that, they get a team, and they try to get the right people to help them, who they can have conversations, build a rapport, then they can then be act as their agent and do the things, and they're worth the premium. Does that answer the question? Perfect. Anything else? On FICs? FICs. I was going to do Dubai actually. Dubai FICs. Anything else on FICs? Family investment company. Please.
I apologise, I missed the beginning.
You, wait, hold on. Pass the little tool over.
Noggin.
Say your name as well.
I can't say anything, I'm meant to be at work today.
You're Brian. You're Brian.
We're cutting that part.
Yeah, so I'm all right. I'm Keith. Sorry, and I apologise because I missed it.
No, that's all right.
In terms of personally owned, this plays no relevance whatsoever.
Really good question. Actually, that's a fantastic question. I think that's one of the best questions. When it's personally owned, you've got to go through a process, and you have to be careful because I've got to be careful that I don't quote the person's name. Someone's made our life very difficult in the public light, working with the current regime. You have to be careful how you incorporate your portfolio. This is for a limited company, yeah? Because when you do it in your own name, it can't work in the same way, and it causes a lot of havoc. So you have to go through a process on getting these into a company, and there's loads of different ways, and they're not a straightforward process, and that's special advice. The normal bit was, normally people have them in a partnership. Starting with that, there's a reason for that.
I'm in that game.
If the partnership incorporates after a reasonable period, depending on commercial affairs, then you can claim something called incorporation relief for CGT, that's capital gains tax, and partnership also has an exemption for stamp duty land tax. There is an equation called sum of lower parts, which actually ends up being zero, right? I would actually, some practical tips when you do it, you don't need to do an SDLT form, but I would, and claim it. Do not do it with a lawyer who does not understand it. Do not do it with financing people who do not understand it, because there is a review of financing if you've got debt on there, and you have to look at the T&Cs. So you need the lawyer to look at the T&Cs who understands it. So we use specialist lawyers for all of this. One little tip, if you are incorporating, I would do it at the moment. There's a case going through. We're involved in that as well. It's going to tribunal. It's going to be quite interesting what the outcome is. Don't do it while you've got debt in term. Yeah, because we don't know. Before, a few years ago, not a problem. Now, HMRC think they got some money, just letting everyone know in it. So you've got to be careful. So if you incorporate with mortgages, you're going to probably have to redeem them and make it not valuable. So you need to wait until that time comes, then tell the lender, I'm going to incorporate, otherwise I won't go with you, and suddenly the magic happens that they're happy and they're not going to do because they're going to lose the business. So you've got to time it really well, and that way you're within the current rules or the current implications. If you do it with debt, you're risking it, because HMRC right now are taking that all the way to court, because they believe, wrongly from my opinion, but it's not my opinion only that counts here, is what the courts decide. So right now that case is in motion. If you incorporate with debt, what the implications are. I don't know why that's a tax problem anyway, as a mortgage problem, but this is the current regime that we live in this government, and you just got to be protected and get up-to-date advice. So I've just covered that bit for you.
So I've got a follow-on question from Keith's question. You mentioned that's limited company.
Yeah.
If you already have your own limited company and you're converting that into a FIC, you can do that?
Correct.
Oh, okay.
So that's where
so
the
it's not
freezer...
like a new one that you have to set up to then convert
No,
it.
but it's a change of structure. So what happens is you freeze it, and that's why I think the gentleman's question was before, you've already got an IHT problem, we've got to attack what you've already built up as an equity in the business.
Because it'll freeze at today's current
At the net asset value.
Oh, interesting.
Yeah, because because the net assets are, so bit of planning straight away. If you do it smartly, timing of everything is really important. Come on, the questions are firing now. Okay, let's finish it.
Hi, I'm Jake. If I have an existing trust, could I move that? Is there a benefit to move
when
that
you
into
say
FIC?
existing trust, without getting into too many details, what type of trust is it, and how is it structured? Is it in people's names?
Yeah,
so
in people's names. And
is it a discretionary trust?
Yeah, discretionary trust, and myself and my brother are the trustees and also the beneficiaries right now.
Okay, so this is after IHT has been paid?
Yeah, well, it previously existed like that. There's no.
So there was a trust ready in place?
Yes, yeah.
Okay, so do you do a 10-year charge and all
Yeah,
that stuff?
yeah.
Okay, so what you've done is you skip to this part,
Mm-hmm.
right? But the problem with that is I would look at, you have to do an evaluation what the 10-year charge is looking at. Yeah, because
Okay, yep.
that's where it's hard until you do all the numbers to realise what impacts are. Does everyone know what I mean by the 10-year charge? So trusts have a 10-year 6% charge, right? Gross assets less debt, less the nil rate band of 325 each. Just a bit, yeah? So we've had to do a few of those because there's a lot of implications. So they used to be great tools just by themselves, but not
yeah.
anymore. So this is why we've got this. Yeah. So there is some planning, but I would do stuff in the future through one of these.
Gotcha. Yeah.
Yeah. Because when you move stuff, you have impacts of exiting, and that's why I said the value. And when you look at a lot of times, the only issue you're going to have is financing.
Yeah.
Yeah.
No one likes to lend to a trust.
Yeah, there is, but they're very unique, and we
Yeah.
probably can get you some contacts on that. But with these, it's still easier to lend compared to those.
Why is that?
Because back to what we said earlier, ignorance. Anything that's not straightforward requires effort and time and all the rest of it. Why, depending on their premium and the commission, why they're going to...
Why would a lender be more amenable to a...
With a FIC compared to a trust by itself? Because a trust by itself is more complicated than a FIC in a sense, because they don't like lending to trusts, right? Because what you're doing here, you're lending because these shares are not in a trust, aren't
Yeah, it's only those ones that are.
they? Yeah, and that's the future upon death.
Yeah, that's not relevant.
Does that make sense? And where the bloodline, everything lines up. That's why, from my understanding. So there's a lot of implications. Sorry, does that answer the question?
Just Tom again. So I don't know if you're going to come on to this, but I have a holding company structure.
We'll do that in the Q&A. I love holding companies. I've done a lot of them. So I think I did one, you can go on YouTube in front of 40, 50 other accountants. So there's an episode. I don't know how the recording is. We'll do it better today. Is that covered fix?
Yeah.
Thumbs up, thumbs up. They're thumbing up. I think I've done all right on that. There's a lot of implications. I know I'm whizzing through, but you've got accountancy, tax, financing, legal, and some things we need specialist advice on, but you need to know what the problems are. That is so important because most people don't go into this. Put it this way, I'm an entrepreneur that happens to have one suit, I ain't got the blazer on, accountant, tax advisor. That's how you got to think. Remember, you're entrepreneurs. You've got to use them as tools like entrepreneurs.